So I guess we can go ahead and get started here. Thanks for coming out, guys. I think it's a really neat thing to see people respond to a meetup event and combine and come together like this. I think it's an indication of the robustness of the Austin startup ecosystem. It's really a fantastic thing, and thanks for Andrew for getting this whole thing started and bringing me on board and helping me do it. So really quick today, we're going to just sort of do a high-level review of term sheets and also the pitch deck piece on it all. I think before I get started, I'll just quickly introduce myself. So I'm Richard Dennenny. I'm the chair of the practice group at Lee & Hayes, the corporate practice group at Lee & Hayes. Lee & Hayes, we really pride ourselves of operating at the intersection of law and business. I think a lot of you are probably familiar with us from the creation of world-class intellectual property assets on that, but we also have a team of about 12 attorneys on the corporate side that really counsel businesses from formation through to exit across pretty much all types of transactions and doing it. My own sort of career journey has been a little bit different than most attorneys on it all. First stage of my career, I was a corporate securities M&A lawyer at K&L Gates in Seattle, 1,700-person law firm, and doing that. I was there with them through 2011 when I had the unique opportunity to jump on board with one of my clients, a company by the name of Next IT, which is a natural language processing company, 150 employees, that builds out intelligent virtual assistants primarily for web self-service. So they're sort of the Siri for business, as we used to say, for people doing that. At Next IT, I was a chief operating officer and general counsel as well, so I ran all the day-to-day functions of the business and being able to do that. So in that capacity, I was responsible for raising capital. So I've been in your shoes as far as going out and actually trying to raise money. We did raise institutional money at Next IT. We also did friends and families and all that, and had a pretty robust shareholder group in there, but certainly was on the receiving end from the business perspective of raising capital on that. I also spent a couple years at a company called Telect, which is a 350-person network solutions provider, and at that company I ran the sales and marketing and product teams at that company on the executive team. Joined Lee & Hayes primarily out of a desire to really combine the operational experience and the legal perspective together to really help partner with clients and like I said, sort of really operate at that intersection of law and business. And so, as you go through this presentation, as you think about Lee & Hayes in the future, I'd really invite you to think about us from a corporate perspective as well. I think we partner really well with clients, especially on the company side and smaller sell-side transactions, doing that, which has really sort of been my primary focus throughout my career on it. So enough of my pitch and about myself on it all, and sort of jumping in on this. The term sheets, I wasn't entirely sure of the experience level or where we were at as a group and sort of talking through it. So I apologize in advance if a lot of this is too elementary for you and going through it, but I thought I would sort of start with the basics and then as you had questions or comments to go ahead and dig deeper on these things. And I think that everyone in this room has a unique experience and perspective as an entrepreneur, as an investor, a service provider, whatever it may be. And to share your stories and have it be as interactive as possible. I think even the discussion we've had on sort of even the appetite and desire to raise capital is something that we all can learn from. We're sort of all in this together. But at a really high level, a term sheet is really just the roadmap for a transaction, and that you're going through that. It generally occurs after the investor presentation, after initial diligence is completed, after they've met the management team, and you're going through and negotiating the key economic terms of the deal. In general, sort of my advice to clients is, especially when you're talking about a venture capital financing, is to go and have the term sheet be as detailed as possible. And the reason why I really believe in that approach as you're going through that is that a company, and I'm saying this from the company's perspective, which tends to be who I generally represent, you never have more leverage than at the term sheet phase. And that's especially the case if you've got multiple term sheets at hand. So either real or perceived competition and scarcity really is your ally and friend, and that you go through the term sheet process and negotiate the key economic terms and then go from there. Now, a term sheet is technically non-binding. So, with the exception of, generally speaking, exclusivity on that one in particular is always a binding provision on that one. But otherwise, they're non-binding. So all the things that we're going to talk around today, liquidation preferences, anti-dilution, redemption, anything else on that, they're not binding. But the reality on it is that people tend to not deviate from term sheets. They may not do the deal if something comes up in diligence or they back out or otherwise on that one, but there's sort of this moral obligation that accompanies entering into a term sheet that for the most part I find and have found that people abide to. So I encourage detailed term sheets and really sort of focusing on the fact that from a company perspective of leverage, and if you're on the investor side, you know, deal flow is such, especially in today's market where we're seeing a lot of deals coming through and access to a lot of deals, there's a true opportunity cost for pursuing a deal, and you don't want to spend that time and money only to get hung up on sort of a misunderstanding of what you're doing with dividends or something like that on it. I think the only other thing on that one that I want to sort of highlight is term sheets really have a whole host of ancillary benefits and issues around them. And so we're talking about the economic terms of a deal. One of the most underrated aspects of the whole term sheet process is really the dance that occurs between a company and the investor. And it's really an opportunity to sort of vet the investor and for the investor to vet the company and understand cultural fit, business model, what kind of partner they're going to be in doing that. And especially when I do represent the investors, I mean, testing the management team's level of sophistication, where they're at, their commitment to the company, going through all that, really tends to come out in the term sheet phase. So it's not only about negotiating the economic terms, but it's also the ancillary benefits on it. From a company perspective, you know, these are some of the questions here that I always want to get out of the way. Before we start talking about valuation and liquidation preferences or any of the economic terms in a typical venture capital deal, let's just talk about the fact, you know, are you ready to raise money? Do you know what you're going to do with the money? And are you really sure that you want to take the money? And, you know, some of my best clients and engagements, you know, I was sharing with some of you guys earlier, are those that decide that, you know, going institutional route for money is not the right move for them. And I think it's obviously a personal decision for any founder group or any leaders of a company to go through, but understanding that when you take institutional money, first of all, there's a clock that's ticking. You know, institutional money puts money into your company expecting a return, and that's their business, and they're going to hold you to that. And so, you know, be prepared. I mean, they're going to need to get paid. Two, you know, control over where your product goes, where your company goes, what you want to do. They're going to have a significant say in all of that kind of stuff. You know, who you bring on board, what your team looks like, access to future capital, all these other things come into play. And you sort of need to think, you know, holistically about the idea of do I want to raise money, and if so, what type of investor am I looking for? You know, when do I need the money? Do I need interim financing in place and going through that? On that note, I'm not going into bridge notes here and convertible notes. Are you guys familiar with that concept and going through that a little bit? Yeah, a little bit. Why don't I spend 2 seconds on that then? So really quickly, so this term sheet discussion is really centered around a Series A financing. So you're going in and you're actually issuing preferred stock. Now, preferred stock versus common stock, you know, at a very high level, preferred stock is a class of stock with certain rights, privileges, and preferences that are superior to the common stock. So it's a sort of a super class of stock, if you will, on that one. Prior to a Series A round, it is very, very common, and in fact, increasingly common to do what you call a convertible note. And that will be effectively a bridge into your Series A. So you'll raise a smaller pool of money, and it'll be a convertible note that says, I'm going to hand this money to you right now. Upon your financing that's scheduled to occur at this point in time in the future, my convertible note is going to convert into that round at a discount. And typically that discount would be 20%, it's negotiable and all that, it would accrue interest and going through that. We can talk about that a little bit later and doing that. But I just want to sort of focus on the fact that you know, raising institutional money in particular is a really seminal decision for any company, and it's something that everyone wants to think through really carefully and make sure that they're ready to raise capital and understand what it means and understand what it is. Yes, sir.
So would you not have a term sheet for that pre-Series A stuff?
You would.
Seed financing?
You would. I mean, yes, you would. Now, I think the main advantage of a convertible note is the amount of documentation required on that is considerably less on that one. You've got a note purchase agreement, and then a form of convertible note is all that's really required on that. What you're effectively doing with a convertible note is punting all of these future decisions around valuation, preferences, privileges, and all that down the road. And so, typically, it depends on the type of investor, but typically you would have a term sheet for the convertible note as well, but it would be much, much, much skinnier than a Series A term sheet. So kind of going through this one, I want to first start on valuation basics. You'll hear people talk about the idea, how much money did you raise? Well, I raised 5 on 10. Or what's your pre-money valuation is 10, or Uber came out of a $1 billion post-money valuation. Those terms get thrown around and going about it, and I think it's worthwhile taking a step back and saying, what is pre-money valuation, what's post-money valuation, and how are those things determined? So really superficial, high level on this, pre-money valuation is the value that you ascribe to the business prior to raising any capital. It's as simple as that. The only nuance that I really want to focus on that one is your share price, which is a function of your pre-money valuation, is, I'll just say with every sophisticated investor, 98% of sophisticated investors, is determined on a fully diluted basis. So what that means when I say fully diluted is you take the number of shares outstanding, so your entire founder class, everyone that's in the group company, all your common shares that are issued and outstanding, so your actual shareholders, and then with that you add in any options, warrants, convertible notes to that to come up with a fully diluted outstanding. I think for that particular issue, are you guys familiar with the concept, of employee stock option plan? And that is it's a very, we hear about it, it's a common vehicle in doing it. Typically the range on those for a company will be between 10 and 20% of your outstanding shares are reserved for a stock option plan. It's applicable here because as a founder in particular, if you own 100% of the company and you're selling 25% of the company, you're going to assume you're going to have a 75% ownership interest going forward. It's actually not going to be true because the investors that are coming in are going to force you to go through the analysis of saying, how many shares do you need to reserve for issuance to your primarily senior management team, executive team, and going through that, and that will get counted against you. So if your option pool is 20%, the common stockholders, the founder group, is going to take the dilutive effect of that 20% before the investors come in. And it just sort of reflects, it's called the option pool shuffle in some circles. But the idea is that investors don't want to take that dilutive impact from that raise, and they really force it on. So long way more, that's its own presentation, sorry about that. But pre-money valuation, money ascribed to the company prior to raising any capital, determined on a fully diluted basis. And then post-money valuation is simply just the pre-money valuation plus the post-money, plus the amount invested on that one. So under a scenario where I say, okay, I'm going to raise $5 million of capital on a $10 million pre-money valuation, that means that I have a $15 million post-money valuation, and those investors that came in own 1/3 of the company. So 5 out of 15 of the company. Again, a little bit misleading because of the option piece on it, but that's sort of that concept on it. Kind of, and this is something that I certainly experienced when I was on the entrepreneur side and on the business side of the thing, is that evaluation is really an overrated concept in a lot of respects on it. I think we hear a lot of numbers, especially around sort of this idea of unicorn investments and startups out there. That's that $1 billion Uber investment on that. Wow, it's a $1 billion pre-money valuation for a startup company going through that. It's always a little bit misleading, because if you ask any sophisticated venture capital investor, they'll allow you to, what you want your valuation to be. I'll let you pick valuation if I can determine every other key economic term in the deal and working through that. And in particular, it's around the liquidation preference. And so before I go into that, are you guys sort of familiar with liquidation preferences and what that means and kind of going through that? So back to this concept of preferred shares. So preferred shares have rights, privileges, and preferences. They're captured in your articles of incorporation or certificate of incorporation, if you're a corporation, which I'm assuming these are all corporations, that are akin to contractual rights with the company that give you priority and preferences over your common stockholders. And one of those, and the most powerful one, is what they call liquidation preference. And that's the right of the holders of the preferred stock to get a return on their dollars prior to the common stock. So there's this concept in capital raising that's always, last in, first out. And that's a real true thing for the institutional money. if you're the last investor into a company, you're going to get the first one out, and the way you're the first one out is through a liquidation preference on this. You know, you're sort of seeing it sort of in the general overall market, a little bit of compression around liquidation preferences and going through that, but the vast majority of institutional deals, the vast majority have a liquidation preferences. They range in size typically between 1x and 3x, so 1 times your initial investment or 3 times your initial investment, with 3x being sort of an outlier on that one. For the most part, it's sort of the market's moving more towards a 1x, and actually a 1x, what they call non-participating. And I'll go into what that means, what that doesn't mean here, but 2 types of liquidation preferences, non-participating, participating. So going back to this idea of 2 classes of stock, common stock, preferred stock. Non-participating preferred stock means that I've got a liquidation preference, so I'm guaranteed upon a liquidation of the company, which is generally defined as sort of any type of M&A transaction, sale of the company, any type of exit that creates a liquidity event for the company, not a sort of bankruptcy liquidation scenario, although it'd be applicable too. Non-participating means that I get my liquidation preference, and that's it, unless I convert to common stock. So preferred shareholders, I'm just going to say all the time, have the right to convert to common stock. That's not technically true. You can have different nuances on this thing, but for the most part, non-participating, as long as they stay preferred shareholders, I get that liquidation preference, and then if I want anything more than that, you know, and there's more to be had, I need to convert to common stock. Participating preferred shares, on the other hand, means that I get my liquidation preference, and then in addition to that liquidation preference, as a preferred shareholder, I get a share pro rata with the common shareholders of, you know, in any proceeds in excess of the liquidation preference and doing that. A really powerful tool. There's a bunch of different nuances on this. You can have what they call capped participating preferred, which will say, okay, you get your liquidation preference, and then you get a participate pro rata with the common shareholders up to a certain cap, and then you have to make the decision either convert or not to convert, and go through all that.
Is all of that in the term sheet?
It's all going to be in your term sheet. You know, in fact, I would argue that if you were only going to address two terms in your term sheet, it's valuation and liquidation preference. I think there's enough sort of understanding of the general market that you could probably navigate around the remaining terms, but you always want to get your liquidation preference dialed down and understood, especially the impact to the common shareholders and all that can be fairly dramatic, which is sort of illustrated on this one. So let's just assume a scenario where it's a $1 million investment on a $3 million pre-money valuation on this one. So the next day, now this would never happen, but I just wanted to, you know, sort of put it out there for illustrative purposes on it. You've got a $4 million exit. So post-money valuation, it's a $4 million exit. With a 1x non-participating preferred, so they invested $1 million, they're guaranteed to get their $1 million back at a $4 million exit. All they get is $1 million. So let's sort of walk through why that's the case so that you understand it. I'm a preferred shareholder. I own the Series A stock with a 1x liquidation preference. I own 25% of the company, and I also have a 1x liquidation preference. Well, whether I take it as a common shareholder and get 25%, or I just get my liquidation preference, either way, I'm getting $1 million. Switch it over, and it's a 1x liquidation preference participating, meaning I get my liquidation preference, I get my $1 million, and then the remaining proceeds left, I share pro rata, so that remaining $3 million, I share with the common shareholders. So in a post-money valuation of $4 million, where there's a sale of $4 million, the preferred shareholders with a 1x participating preferred, which is a very common deal structure for preferred shares, they're going to get $1.75 million. And you're sitting there thinking to yourself, I just sold this company, I just sold 25% of this company. How did I just concede 45% of the economic value of this company on that one? Well, you did it because you agreed to 1x participating preferred. So it's a pretty, there's more value adjustment in liquidation preferences than anywhere else on a term sheet. So I think we'll sort of walk through this one and talk through, and this ties into this idea of valuation can be a little bit overrated. And so you've got 2 options here. You know, one, you've got the ability to take a $5 million investment on a $10 million pre-money valuation with a 1x non-participating preferred, or option 2, 5 on 15 with a 2x participating preferred. You know, in one scenario, you're selling 33% of the business, the other one, you're selling 25% of the business. And you know, as a company and a management team, you're going to have to look at that and say, you know, which one do I want to take? You know, sort of any thoughts there or opinions, or I'd take either, but you know.
So you're saying from the company's perspective, as somebody that's already there,
or an investor, either way. I mean, just you know, from you know, a thought on that one. I mean,
well, how many investors are there?
Yeah, you're just on your own. You're putting all $5 million in.
Two? Yeah. Is the company not one?
Yeah, I mean, I think in general that's right. I think the real answer on this one, and I'll walk through sort of the economics on it. It completely depends on your exit. And you go through that is your exit value, and so and it's really illustrated on this one. But as a general matter, you know, a lot of numbers up here and everything else on that. But the high level concept is that the power of a multiple liquidation preference diminishes when it's non-participating, diminishes the larger the exit. Sort of the normal inflection point on this is if you can get, you know, 8 to 10 times your post-money valuation, you're better off taking the option 2. If you're going to be less than that, you are better off taking option number 1 and going through that. And from an investor perspective, you know, I think it really comes down to how much downside protection do you want on this thing. So looking at option 2 on this one, it's a company that doesn't meet projections, doesn't go where it wants to go, but doesn't fail, and sells for $10 million. Very common scenario, frankly, on that one. As a company, at a $10 million exit with a 2x participating preferred, yes, it's all gone. It's going through that one. Kind of go through this, and you can sort of see on the line how this all works itself out there. But at that 8 to 10x return on your post money, it sort of flips on that one, and then all of a sudden you were better off, you know, with a higher pre-money valuation and selling less of the company and not working through that. So when you're going through the participating preferred analysis on it, you know, it's a classic game for the institutional investors. You know, everyone you want to talk to, no, this is going to go public. This is going to be the new WhatsApp on this, and it's going to sell for $19 billion and all that kind of stuff. What are you doing? Worried about, you know, down round protection, going through all that, and that's sort of where you see the multiple liquidation preferences. But it's that inflection point of when when the conversion has to occur to participate and go through it 8 to 10 times the post-money valuation is sort of the way it works out. But a huge thing on this one. Now, I think when you're going through liquidation preferences, and this is something that I've lived not on the business side. Thankfully, neither of the companies I ran had this issue in it, but I have as a lawyer on it. The liquidation preferences really have the ability to create divergent interests between the preferred shareholders and the company. And that's primarily the case when you've got multiple liquidation preferences. So going back to this scenario where you've got a 2x non-participating preferred liquidation preference. So I put in $5 million as an investor on a $10 million pre-money valuation with a 2x liquidation preference, which means upon a liquidation, I get $10 million. And as a rational economic actor on this thing, I'm not going to convert to common stock until I'm going to get more money as a common shareholder than I would as a preferred, which is an owner of 1/3 of the business, doesn't occur until $30 million. So for that investor looking at this one with a liquidation preference of 2x and doing that one, they could care less, frankly, if it's a $10 million sale or a $30 million sale. That's not true. Everyone wants to be associated with a successful company. But from a pure economic perspective, they don't really care. You know, I had a client, the founder's name was Fred on this one, and we lived this together. And, you know, as a company, the investors put in $5 million, just like kind of a similar analysis to this one. Company went, did fairly well. About 5 years later, the investors really started to get itchy to have their money returned to them. It sort of became pretty clear that the valuation range for this company was going to be somewhere in that $20 to $30 million range on it. And the investors used what you call a redemption right, which I'll get to later, to sort of try to force the company to go on the market, knowing that from the investor's perspective, all they wanted was a liquidity event because they were going to be made whole, and that because the valuation range was already bound by that sort of $20 to $30 million, they didn't care if it was 18 or 30. Yes, sir.
So an interpretation of that is that participating helps keep everybody on the same
It does.
interest.
It does. I think when you're thinking about, you know, and the market's moving this way, it's actually been a really encouraging sign. The market is moving primarily to actually a 1X non-participating preferred, which is a pretty dramatic shift over time, and I think, you know, there's a bunch of different theories on the dynamics for that, why that would be the case, but from aligning the company's interests with its investors, either a 1X non-participating, because what that means is, okay, investors, you're going to get your money back, and you're going to get a premium on top of it, so it's lucrative to you, but at least we're all sharing the incremental value above the liquidation preference. There's not this no man's land where you don't really care. Better yet is a 1X non-participating at all, which says, okay, yes, if this thing blows up and it's a true fire sale, you're going to get your money back first. That's not what any of us are in this for. We're going to realistically, on any likely exit, you know, this is either going to be, you know, frankly, companies either make it or don't. I mean, you know what I mean? And so, you know, you're going to get your downside protection, but realistically, for any likely exit, you're gonna convert, and we're aligned. And so you're exactly right. You're exactly right on that.
Well, they're going to convert. Okay.
Yeah. Well, your interests are aligned on that one. So again, so they would be treated the same from their analysis of a potential sale transaction with a 1X non-participating would be the exact same as a common shareholder. Right. They're going to run the same, what they call waterfall analysis is the term that's used to sort of show the flow of funds throughout your investor pool and going through that. And every investor at near a liquidity event runs their waterfall analysis, and their waterfall analysis under that, you know, the 1X participant or non-participating would be identical to the common. That's what you want, interest aligned. So sort of be aware of it, that when you start playing with multiple liquidation preferences in particular, you know, interests aren't aligned. I think it's kind of interesting here where you've really started to see a lot of multiple liquidation preferences are in those unicorn rounds with the $1 billion valuations on that.
And how big are the gaps?
Well, I mean, I don't have the actual deal terms themselves, but what's really happening there, or at least the speculation, and I agree with the speculation on it, is that there's a desire by the companies to be able to publicize a $1 billion valuation. And doing that. And then you're having a rational conversation with your investors. How do we bridge a valuation gap? I only think you're worth $500 million. You think you're worth, you know, $1 billion. Well, the way you do it is you have a really aggressive liquidation preference. From an investor perspective, it's also, from an investor perspective, you say, okay, I'm going to get a 3X liquidation preference. This company, Uber's not going away. If there's value here, we know you're going to have a liquidity event through an IPO. We're going to monetize it, and I'm going to get 3X on this thing. I don't care what valuation you apply because I'm going to get a 3X return, and I'm not expecting to participate in the upside potential on it. Some of that dynamic, too, I think is informed by the fact that for those unicorn-type investments, you're actually seeing sort of not your traditional VCs. You're seeing sort of more, you know, private equity and companies, kind of a different type of investor class as well on it. Does that sort of make sense? Comments, thoughts, otherwise? But it's a dangerous precedent early on in particular to bridge a valuation gap through liquidation preferences. So, you know, it's the classic thing where you might as well go into that. So, yeah, sort of when I say liquidation gap, that sort of people get what I mean. It's, I think my company's worth $50 million. You think my company's worth $10 million. I still want to take your money. You still want to put your money into the company. How do we find a way to bridge the gap? Liquidation preferences is how you'll do that. The reason why I say, you know, for those later stage rounds, you can kind of get away with that a little bit, is because when you're talking about a Series A, you're taking on your first institutional money as a company. You're going into it. With that first round, you're really setting the DNA for your future fundraising efforts. And just understand and realize that if you agree to a 3X liquidation preference at your Series A round, and you're going to raise money going on, I guarantee you your Series B round is going to want to stack on top of that. And so, you know, which is why, you know, 10 years ago, seeing multiple liquidation preferences was a very common deal, and you go through that. And nowadays, it's like, roughly about 3/4 of deals are actually done on a 1X non-participating preferred basis, which is almost a complete reversal of where it was 10 years ago. And sort of my own belief on why that's occurred is the company likes it too, but I actually think it's more investor driven. That the investors looking at it as a Series A round, and I'm talking Series A round on that 3/4 are 1X non-participating. But from a Series A investor perspective, unless I am so confident I've got the war chest to make sure I'm going to, fill all the future capital raising needs, if I sign up for a really, heinous, for the company, heinous term sheet, someone's going to sit on top of me. Last in, first out. And so it's actually been, I think, the Series A investors and the investors I represent, certainly it's held true for, are actually trying to drive more towards a reasonable liquidation preference to avoid that legacy capitalization issue and going through it. It's not as, like I said, not as applicable later on, and actually as you go into series, might as well explain this. So when I say preferred stock, there can be multiple series of preferred stock. I think I had a E2 series once, was sort of the one that they did a total of 12 rounds. And so you can have multiple, and it all works itself out in that waterfall analysis, so E2 gets this much, then it flows down to E1, then B, not do all that one. Liquidation preferences get a little bit worse over time, generally. I have two other terms on it. So that's liquidation preferences. Any other questions before I sort of do a rocket docket? I'm sort of, as I predicted, talking too much and taking too long. But questions on liquidation? Yes, sir.
So could you comment on the Facebook structure where Zuckerberg maintained control despite taking tons of money?
Absolutely. Yeah, no, it's absolutely right. I mean, you can have voting, non-voting, different classes. So, preferred stock, the corporate structure is remarkably flexible, not quite as flexible as the LLC structure, but remarkably flexible. And you can come in as a non-voting member, and in a public company context, it's kind of interesting. When you talk about preferred shares in a public company context, usually they are non-voting. In a private company, in the VC context, they're not. But yeah, you absolutely could. Generally speaking, an institutional investor, there has to be a lot of demand for like securities for someone to agree to that. I mean, generally speaking, folks aren't willing to just concede control and no voting rights on it. But yeah, you can. Yeah, no, absolutely, yeah. Yeah, Zuckerberg did it's kind of remarkable. I mean, technically, you could have someone own, 1% of the company and effectively exert rights if they sort of, built in their certificate of incorporation, have the right voting agreement with the other shareholders or had them all as non-voting shares, and you could effectively control the company. If you were my client wanting to do that, I'd be really skeptical of your ability to raise capital unless you were really compelling, but you can. And Facebook did it.
Okay.
Yep.
I mean, if they could stay on that topic for a second. So can this actually term change over time? For example, maybe you get voting rights in the beginning for some investors, but then later on you just switch that deal? Yep,
absolutely. It's usually, and it's here with the protective provisions. So any sophisticated institutional investor is going to have a provision in the term sheet that you'll want to have in there, and they'll want to have in there, that says effectively you can't do these types of transactions without my approval. And one of them is always changing any of my rights, privileges, or preferences, which is always effectuated through a filing an amended and restated articles of incorporation or certificate of incorporation. So typically, a investor that's represented and sophisticated in doing that would have blocking rights to prevent that, but absent those blocking rights and everything else on that, or if they agree to do it, happens all the time. Where it's most applicable, so I'm sort of jumping around on this, is when this is called a pay-to-play provision. So, it'll be a situation where, I'm the company, you're the investor, and we've got a valuation gap, but I really want your money. And you say this thing, okay, fine, I'll take your money at X valuation. I know I'm going to need to raise additional capital in the future. Because you were so aggressive as an investor wanting 3X liquidation preferences and redemption rights and everything else on this thing that I can't stand, you're going to agree to provide that next funding, and if you don't, you lose all your rights. And it's kind of, it's not a, I won't say it's common. It tends to, in my deals, it doesn't tend to actually make its way into the actual final deal, but I'd say a quarter of the time, I throw it into the term sheet. It's a way that when you have an investor that's being overly aggressive and you're going through that, it's kind of my way of saying BS. Then, okay, you really want to create a legacy capitalization problem of that magnitude, I'm going to make you own it, and if you don't own it, you're going to lose it all. And it tends to be fairly effective, actually, and going through it. Because, you know, from a practical and, you know, business perspective, you know, an investor who's not willing to step up to that and realizes they're asking that aggressive, the terms tends to come back and be a little bit more reasonable. But long answer to the fact that you know, think of preferred shares as a contractual agreement with the company that usually also is wrapped around an agreement with the rest of the shareholders through the form of what they call a shareholders' rights agreement and or an investor rights agreement that gives you rights. And just like any type of contractual, you know, agreement with certain limitations with law and all that that aren't applicable to what we're talking about here, you can agree to them. And so they can change, and it oftentimes does. You know, typically on these things, in that scenario where you don't have a pay-to-play provision, you've got a liquidation preference, you're at the end of your fund life, and you're not going to put any more money into the company. You realize there's value in the company, but it does need funding to continue on. But the only way the new investors will come into the company is if you take some of your preferences away. And so then you would voluntarily agree to that, because if you don't agree to it, the company's not getting funded, the company fails, and you've got nothing. So, kind of just really quick on this, just sort of in the interest of time, trying to keep it out of within somewhat of a reasonable time frame for an hour. There are a whole host of other provisions here that I consider to be more truly legal provisions that are applicable that I'm not going to get into, around things like registration rights in particular, when you go public and going through that in a venture capital deal or an institutional deal for preferred shares will all be addressed. I didn't want to go into those at all. I just wanted to sort of quickly highlight a few what I consider to be primary economic terms in there, beginning with anti-dilution protection. So you sort of kind of general understanding of anti-dilution, I don't know enough, but what anti-dilution is as an investor in the company, I want to have some protection against the company diluting me, issuing additional shares. I've bought, you know, I invested $5 million on a $15 million pre-money valuation. I expect to own 25% of the company, and I don't want the company to go out there and raise additional capital and dilute me without my consent. And in particular, where that comes into it is on an economic basis, where I don't want my overall, you know, valuation that I own. So I own, you know, $5 million in a $20 million company. I have $5 million worth of shares. I don't want you to issue shares in a down round or for lower than what I bought them for to effectively lower the value on it. In every institutional deal, VC deal on this one, they'll negotiate and include in the term sheet an idea around anti-dilution protection. There's two sort of general ways that it's done. There's the weighted average, which is the most common. I'd say 80% of deals have a weighted average. There's what they call broad-based and narrow-based, which we don't need to get into sort of what that means on it. But what weighted average means, it says that if I own, you know, $5 million of stock on that, you sell an additional $1 million at a valuation less than what I did, I get trued up on the delta of what I lost on that one. Full ratchet means that if you sell stock at a price less than what I bought it for, my valuation immediately gets reset to that lower valuation on it, which is a fairly rare provision, because what that means, sort of walk through that, is a $5 million investment on a $15 million pre, so $20 million post, 25% ownership, $5 million in stock. I sell, as a company, I sell, you know, one share for $1. I bought my shares for, you know, $5 a share on that. All of a sudden, my value goes down. I now effectively own the company. You know, you get a 5x bump in your conversion rights on that one. So it's rarely included, less than 10% of the time. And then when I have had it in deals, it's usually really limited by time frame. So that in the next 6 months, If you issue shares, I get it at that valuation, and I get reset. After that, I move to weighted average. Only time that really I sort of focus on that one is if a next tranche is imminently sort of contemplated, and I've got a lot of anxiety that I'm paying too much on this one, the next investors are going to come in lower, and I want that full ratchet protection. Otherwise, it's not there. Dividends. We all get the idea of dividends. Familiar with that? Was there a question on?
I just want to make sure I understand that this anti-dilution protection, you're still looking at a single body of shares that never gets increased, right?
Yeah.
These kinds of things we're talking about here.
Yeah.
Is that a rule, by the way? I mean, that never happens, that they actually increase the number of shares that are possible?
Oh, no. No.
It can be done also.
It happens all the time. So a typical fully negotiated anti-dilution provision will say that, so I kind of get into the technical aspects of anti-dilution. The way you effectuate an anti-dilution provision is actually through your conversion rights. So when you buy your shares, your conversion right is 1 preferred share to 1 common. If you sell stock for 50% of what I bought it for, under a full ratchet, my conversion right is now 2 to 1. It immediately resets on that one. And then as you work through it, so we're negotiating this one. I say, okay, investor, what's not included in this one is we're going to accept out any additional issuances to employees, management, board members. We're going to exclude out of this one, any, financing arrangements for, whatever, anything that there's a host, primarily the option plan is what you try to exclude. But it's common, yeah. I mean, you'll increase it. Yes, sir.
So I don't know how this fits in the order of your presentation. It may be better to say this.
No, never.
Okay. It's two questions. One, in that clearly you sort of have to have representation to actually do a deal.
Yeah.
And, but
never. Burn my card.
but what kind of budget, right, does one need for that, right?
Yeah.
Obviously it varies, but you need an order of magnitude number,
yeah.
right?
Yeah, no, anyone in this room that wants to do a Series A deal, fixed fee, 10 grand. 10 grand, maybe 15 if it's complicated going through it all.
Cheaper than I imagined.
Yeah, it's changed over time. I mean, I think, let's just have an intellectual, honest conversation on this one. 10 years ago, it probably would have been 2x that or 3x that. And you and I would have spent 2 weeks together working on a private placement memorandum. We would have detailed out risk factors around it and had a full-blown sort of offering documentation set going through that. Sort of with the regulatory changes that have occurred and sort of overall comfort levels with it, it's gone away. The other thing that's really happened with the investment community is these terms are starting to be really well understood and accepted on this thing. You can go to the National Venture Capital Association and go to their website and pull up their form agreements. And if you handed those to me as our starting point, we can start with those.
And the other question that relates with that, certainly you would be on the side, but from my experience in anything, you want a working relationship with somebody before you have a term sheet.
Well,
that's in the games, at least has been. It's like in the fundraising experience, right? Is again talking about Series A, is a kind of does it add substantial value to be talking to you at what point in the process before you're at a term sheet?
Yeah,
that's the way to say it.
Well, so I think everyone's got their own relationship with their counsel. I think from a personal perspective for me, and some of this is sort of a function of the fact that I've spent, a third of my career in operational roles on the business side of it. I tend to get engaged really, really early. I tend to work with my clients in putting together their pitch decks. I tend to be the one that puts them in front of their first investors. And so it's kind of that type of engagement and going through it. In other models where you go through it, I mean, some investors or some companies won't get their counsel involved until the term sheet phase. I think it just depends on how you want to partner with your attorney and what you want that relationship to be. And some of that is, not some of it, a ton of it is defined by your own comfort level and want to do that. I mean, Does that make sense? Is that what you're asking?
Well, kind of, I guess, as I wound up doing some consulting things, but just, it seems like if you have somebody that knows stuff, it's cheaper to have them tell you things sooner rather than later.
Well, going back to slide 1 or 2 on this thing, the most significant, negotiations and the course of your company's future capital raising efforts are going to be determined at the term sheet phase. And you want to, if you're not familiar with the terms and sort of where the market is and how you go through that, talk to a lawyer at that stage, and ideally even before that stage when you're talking about going through that. Otherwise, once you've got the term sheet in place, you're really just leveraging your attorney to be the scrivener and make sure that you comply with all securities laws, which is an important function, but I think you've lost a lot of the value proposition you can have from a lawyer. It's also something too, frankly, find the right counsel. It's an hour conversation. It's where lawyers really add value you find a lawyer that you can trust, that can think through your business, knows what you're trying to accomplish and doing. You call me up and we just talk through it. It's a half-hour conversation, hour conversation. It's worth it.
You mentioned talking about getting counsel for your Series A, but I worked with a guy who was putting together one of these things, and he was laying out all the series that he anticipated being possible.
Yeah.
Is that
waste of lawyer fees?
Is it?
Yeah. Yeah.
Because it seems like they'd be related to each other, because a lot of this stuff has to do with what happens later. Some of this is how you decide to, practice law and go about these things, going through that one. Both from a business perspective and a legal perspective, I try not to, trying to lay out that roadmap in that level of granularity, which is going to require, in that situation, if you make any changes to any of those future Series A, you're going to have to file amended restated articles anyway. And so trying to pretend that I'm going to be able to predict the future with that level of certainty seems like a fool's errand. One step at a time makes sense.
And doing it. And you don't know, and sort of related to that, and I think it's a question I get all the time on it, is okay, I've got a company, Rich, I'm an LLC. What's that mean for me, and am I going to be able to raise money on it? And the answer on that is not from institutional money, not yet. And going through that, oh crap, okay. So talk to me about what it's going to cost and what the structure is going to be to do a conversion to a C Corp, or what we're going to go through and going through all that kind of stuff. And we'll talk through that, and it's less than what they think it's going to be. But I still say, meet with your investors, let's get the term sheet determined, and let's not go through that process until we're further along in the road and going through that, because it's far from certain you're going to raise the money. If you say on your own you want to stay in LLC and enjoy the pass-through benefits, taxation benefits of it, and doing that. And so that's kind of but that's, it's different by attorney to attorney, but I'm a big proponent in
don't overplay the future.
Don't overplay the future, and don't try to pretend you can over-optimize it. So, I don't know.
I've seen examples where you're right.
Yeah, well, but now
you take the future into consideration.
You do. So the conversation you and I would have on that, when you say, okay, Rich, I want to have I'm going to have future capital raising needs. Say, fantastic, that's awesome that you've gone through and had enough self-reflection to really understand what your needs are long-term, and that this first round isn't going to do that. We talk through that when you, and then you say, I want to go ahead and define all those up front. We'll say, can't do that. Say, okay, but maybe we do something what they call blank check preferred. Then, okay, we're going to create a vehicle that makes it more flexible for you to do that in the future, so you don't have to go back to shareholders for approval, but let's still not pretend that you can do it, that you can. So let's absolutely have that conversation, optimize the structure to facilitate it, but not try to pretend I can predict the future with that level of certainty. Kind of that.
Rich, I've got a question.
Yes, sir.
Thanks for letting me attend remotely. But I wondered when a term sheet is considered to be an offer under contract law.
Well, you know, sort of the whole idea of offer acceptance consideration as the hallmarks of a binding contract on that one. You know, you're hitting on a very sort of nuanced point on it. So, you know, it's a, you know, every well-drafted term sheet will it just, you know, specifically say it is non-binding. And so that by contract you agree it is not binding except with respect to, you know, exclusivity and the repayment of fees. Or, you know, whatever, you know, that kind of, you know, but primarily exclusivity in doing that. There are a whole host of sophisticated investors out there that, notwithstanding that term in that provision in the term sheet, will not sign the term sheet. They just will not execute it. I'm of the opinion, and 95% of my deals end up having a signed term sheet, and then we rely on the fact that it's non-binding. But there are a class of primarily investors out there that don't want their signature on something that can kind of create that, and the sort of the classic fear example is, well, they're going to combine that with a couple of misconstrued emails and everything else on there doing it. So is it a risk? Yes. You know, theoretically, I've never seen it come through in that context. You know, you've got kind of related ancillary areas of the law, primarily around commitment letters for banks. Is kind of the analogous area of the law where people kind of say, well, banks get sued all the time for non-binding commitment letters. When does that start to get applied to this one? You know, so it's an issue. I tend to have term sheets signed though, and I think you rely on the non-binding nature of it, and except for the exclusivity provision, it's not a binding contract. Any personal views on that one?
Okay. No, I have done a lot of term sheets, but I've never had one signed. So, but I don't even ask for signatures. So. Yeah.
Yeah. No. For the larger, I mean, for the larger funds in particular, I mean, you go to Intel Capital, and you know they were an investor, and there was no way in hell they were signing. They just weren't willing to do it. So you know, I'd say I'm assuming you're probably dealing with the larger class of investor.
Well, I work for a university, so
okay.
But yeah, we just never ask for signatures on our term sheets. But we do send them back and forth by email, so I guess that's a form of recognition.
Yeah, I think that it's you know, especially from the company side, you know, although it runs both ways, I tend to get them signed. And rely on the non-binding nature of the agreement. I mean, from a purely technical perspective, offer acceptance, consideration on it all, I mean, what you've agreed to in that non-binding term sheet is the only thing that's binding is exclusivity. And you're signing it only for binding purposes of on exclusivity. And so it's hard for me to imagine that there's much risk involved with someone coming after the fact and trying to enforce it with or without the signature on it. But there's a divergence in the practice there, without question.
What's the next step? If you have a term sheet, it's just a piece of paper with some ink on it.
Yep. So go through.
What do you have do you then follow that up with a formal contract?
Yep, exactly. So you go through the process. You have your initial investor presentation. Typically, find the investors, present to them. Typically, then after that, if they're interested, your whole goal will go into pitch decks here in a second. But whole goal is to get their attention and want to engage the next level. Usually we have a mutual non-disclosure agreement signed at that time. It's from my experience, and this is also, there's a little divergence here in how people practice, but I usually don't ask for, I rarely ever ask, I don't know if I ever have actually, ask for a non-disclosure agreement before a presentation. You know, instead the company don't disclose something that's that proprietary that you can do it. Have your investor presentation, then get a non-disclosure agreement signed. They'll have sort of initial diligence, which really primarily consists of management team meetings, and you're going through the business model and the financials, kind of going through all that kind of stuff. You'll then sort of go through the term sheet process. Once the term sheet process is done, they'll do a deep dive on your diligence and really start to get into sort of the specifics. And, you know, there's a whole, you know, scope of what you want to open up or not open up, but it's deep. And then usually in parallel to that, depending on how scary you think the diligence is going to be, you'll negotiate definitive documents, which in a typical Series A round will include, you know, your stock purchase agreement, amended and restated articles of incorporation to define all the rights in doing that. A voting agreement that says here's how all the shares are going to vote. A shareholder agreement that you get all the other shareholders in the company to sign that says here's how our relationships are with each other. If you sell, I have the right to sell with you. If you sell, I have a right of first refusal, all those kind of things with it. And then you can even get into more sort of granular specifics on it with indemnification groups and all that. But term sheets are later in the process, followed up by deep diligence, definitive documents.
Does your 15K cover in that the whole thing, or just, I mean, when you say that the legal fees may be in that 10 to 15K range?
Yeah, no, the whole process. Yeah, soup to nuts. You go through it all. I mean, the lawyers, especially on the company side of it, I mean, you know, especially for a Series A round, typically the diligence is not that robust. There's not usually that much involved with it, and you're going through it, and you can do it fairly quick, you know, it all. But yeah, no, the whole process. You go through it all. You know, most of the fees are generated at the definitive document stage. You know, you can drive. I mean, if you don't do a good job of getting the material business terms agreed to at the term sheet phase, and there's a lot of either ambiguity or disagree, you know, or you just don't address it, you know, you can end up spending a lot of time with the definitive documents. But you really, again, this is not an area at that stage that needs to be overlaid. Going through these, last, just real quick, redemption. Redemption means I own shares, company, you have the right, you have to buy them back from me. It's a really dangerous thing because the company needs to come up with the money to buy them. To bet the company provisions. Because if you can't buy them back, you need to sell the company. So rarely agreed to, but they're out there, and when they are, you just go into it accepting the fact that you have a hard stop, that as soon as their redemption rights are triggered, you better either be, you know, wildly successful with the capital to be able to buy them back, access to additional capital that'll take them out, which is difficult to do because new investors typically don't want to come into a company just to have those proceeds paid out to another investor who's getting bought out. And doing it, so be careful with it. It's out there and doing that. Voting rights and board seats, count on institutional money having a board seat. Sometimes, and this is for the gentleman on the phone, it might be applicable for you as well. You know, oftentimes the folks that are worried about, you know, there's folks that don't want to sit on the board because they don't want to have fiduciary duties to shareholders. And so then they'll take observer rights instead of a board seat fiduciary. Observer means that I have all of the access, with usually a couple of exceptions that a board member has, but I'm not subject to the fiduciary duties of a board member. But so a lot of that. Protective provisions, you're going to agree with the investor that you're not going to do certain things without their permission. Right, first refusal co-sale. I have the right to buy any shares that you issue in the future, first right. Co-sale, another shareholder sells their shares, I have the right to sell with them. I don't want anyone else creating a liquidity event in this company unless I have the right to participate with them. Drag-along rights means that if I want to sell, usually it's qualified by a certain valuation threshold, if I want to sell, all the shareholders are prospectively agreeing to sell with me. And we're going to do that. Pay to play, talk through it. You're not willing to step up to the plate again, you lose. Kind of go through that. That's it for the term sheets, and I'm already right now at exactly an hour on this thing. Sort of already traded all these things. I don't need to reiterate them. I think the only thing I'll add to this is vet your investors. You know, I'm going to bet that getting money from an institution is a lot better investor than some other investors are. Not all investors are created equal. Who are they going to be a partner? How good a partner they're going to be? We took money from, I'll use their name, a group called Union Bay Capital, and they put money into the company, and they were such a value-added partner for us. They had a long-term vision for the company. They understood where we were going. They understood our technology. They had access to the markets that we wanted to get into and doing that one. And frankly, that impacted sort of the overall analysis, evaluation, everything else on that. Their dollar was worth more to me than another type of investor. And so vet your investors and go through that. Don't be afraid of reference checks. You know, these investors have a portfolio of companies that they're dealing with, and talk to their CEO, talk to their management team, and how are they to work with, because a bad investor can make life really, really difficult for you in going through that. And then the other thing I'd say that's not in here is, as you're negotiating this term sheets, the single best question you can always ask an investor is, why do you need that? Why do you need it? And don't be afraid to ask it. And get it on the table and what they're doing, because there's something driving each one of these terms that's going in there. There's an underlying issue, and surfacing that is a very valuable tool for it. So that's it with term sheets. Hopefully that's kind of useful and all that. I can end it here for folks that want to, and do that. The next few slides, we're going to go through sort of what I consider to be the 10-minute pitch. It's really, I'm just frankly stealing this from, you know, when I transitioned from law to the business world, and one of the very first things that I did is I went to what they called a pitch clinic, and it was, you know, it was a full day process. You go through that, and I'm stealing their materials, and so I'll give them credit going through that. But we can sort of, you know, for those, why don't we take a 5-minute break, and folks that want to sort of get up and leave and head out of here, we can. The next 10, 15 minutes will be sort of spent going through the pitch deck and sort of my thoughts quickly on sort of how I structured my investor presentations and what I went through, and we can hear other stories and go from there. So with that, we'll end it for now.